Ladies and gentlemen, welcome back to the channel. I came across an article on NBC as to the reason why the stock market is down today. Bond yields are climbing. Here's what that means for mortgages and other consumer borrowing. Resurfacing fears about inflation are pushing longer maturity bond yields to multi-decade highs. The rate on the 10-year Treasury note is the main benchmark for mortgages, auto loans, and student debt. In some cases, consumers could see their monthly payments increase exponentially. Against the backdrop of persistent inflationary pressure, yields on longer-term bonds have been climbing, which experts say is likely to keep borrowing costs elevated, particularly for long-term fixed-rate loans such as mortgages. The yield on the 30-year U.S. Treasury bond hit 5.323% on Tuesday, a 19-year high, before edging down to just 5.3%. The 10-year Treasury yield, a benchmark for fixed mortgage rates and other long-term loans, is above 4.7%. That compares to below 4% below the start of the before the start of the Iran war at the end of February. And this is a graph just showing you the 10-year Treasury. The higher bond yields on long-dated securities like 30-year Treasury clearly indicate discomfort over persistently high inflation in the future, said Lawrence Yan, chief economist for the National Association of Realtors. The annual rate of inflation was 3.4% in July as measured by the Consumer Price Index, far above the Federal Reserve target of 2%. Before the war in January, the annual inflation rate was 2.4%. What bond yields mean for mortgage rates? Since 15 to 30-year fixed mortgage rates typically follow the lead of Treasury rates, higher yields have already been pushing up mortgage rates. The average rate for a 30-year fixed rate mortgage was 6.75 as of Tuesday, after finishing last week at 6.69, according to Mortgage News Daily. The impact on mortgage rates is directly related to higher bond yields, Yen said, independent of the Federal Reserve policy. High inflation and higher overall long-term borrowing costs will remain higher mortgage rates. He said consumers should not expect any meaningful decline in mortgage rates. This is actually really not good for anyone trying to buy a home right now, because they're saying they should not expect mortgage rates to go down. But I feel always look around in the market, see if you can find a good deal, see if the seller is really willing to give you a good deal, like buy down the rates or something like that. Just always be in tune with what's going on in the market. Last week's favorite economic data provided temporary relief, said Jeffrey Dargahan, a Loan Depot's chief investment officer and head economist. High energy prices stemming from the Iran conflict remain an important part of inflation, he said. So long the Iran war is going on, we should expect inflation rates to keep on going up, especially with oil and gas prices. Long-term bond investors may need more evidence that the post-pandemic inflation cycle is truly behind us, and that the economy is returning to a slower growth, slower inflation environment before 10 and 30-year Treasury yields move meaningfully lower. In the meantime, there are always ways to offset higher rates, experts say. Some want to consider short-term mortgage rates, like 7-year adjustable rates. That's an ARM. And unless you're really sure, an ARM, it depends on your financial position, but ARMs can be really tricky. You have to do your research to see whether that's right for you and your family's need if you're trying to purchase a home. I'd rather go for a fixed mortgage rate, but everyone's needs is different. I personally would rather have a fixed mortgage rate. What bond yields mean for other consumers? Rates on car loans, credit cards, student debts are also directly or indirectly tied to bond yields, meaning those payments could increase as well. So it's not just mortgage rates. Car loans, credit cards, student debts, all these could increase as well. Auto loans are also susceptible to broader economic factors. So auto loans as well are also affected. So in short, bond yields is something that a lot of people should seriously follow when they're not sure how the economy is doing. Just have a curious mind about some of these terms and what some of these numbers actually mean. It doesn't take a lot to figure out. It's a keen interest in knowing what's really going on. Because I saw, yeah, the market is down today. Why is the market down? It doesn't make any sense. So what's going on? Yes, Iran war and conflict has been going on. Yes, that's understandable. Yeah, that has been going on. But what else is affecting the market? So bond yields were shooting up higher today, causing a sell-off in some, or should I say, most of the stocks, so the biggest stocks that I follow. But guys, this is a great article by CNBC. It's very self-explanatory, and one thing I'll leverage or do encourage, if you're reading an article or if you're watching any of the videos, and sometimes if you're not really sure how about a term, you've heard about this term several times over and over and over again, and you're just not really sure what this term is all about. My suggestion is to leverage tools like Claude, ChatGPT, Gemini, Meta AI. Leverage these softwares and these tools that we have, and just do a research. It doesn't hurt to learn more about something. What does this mean? What's the actual meaning behind this? Because in society, we go through a situation whereby we focus a lot on things that don't add value. We know a lot about them, but the things that matter to us, the things that affect us on a daily basis in terms of finance and all that, we tend to ignore those. We hear certain terms before. Maybe you've been hearing the term for the past 5 years, but you just have not taken your time to really learn and see what does this actually mean. So it's just having that keen interest. That's one thing I would encourage everyone to do. This is the Invest with Dennis channel, guys. This was just a quick analysis of bond yields, and courtesy to CNBC. It's very self-explanatory. I was just reading through it just to see what is really causing the market to go down today, and in the future. Now you know about bond yields. You can do your own research and find out more about what they are and what they do. And please feel free to subscribe. You can find us on YouTube. You can also find us on TikTok and Instagram. And thank you so much if you have been following me and have gone through the end of the video from start to finish. I appreciate you guys. But thank you for deciding to watch my video, and please support the channel. It helps us grow. Peace and blessings to everyone, and I will definitely see you in the next video.